Hello and welcome to this latest weekly market recap for the week ending Wednesday, October 22nd, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to be with all of you again this week. Got some interesting stuff going on. Earnings season really kicking in now. We've seen the 10-year Treasury yield drop below 4% for 4 of the last 5 days. And like I said, as earnings continue to pour in, we'll get a better sense of what this market's going to look like in the fourth quarter. But some of the bigger names now starting to report. We had a report from Netflix on Tuesday evening. Just in on Wednesday evening is Tesla. We'll go over both of those charts in just a bit. But first, let's go ahead and take a look at what happened this past week. So we're going to move over, start with the major indices. And over the course of the last week, transportation stocks have been leading, gaining 1.44%. Dow Jones, NASDAQ, S&P 500 fractionally higher over the last week. Real weakness on a relative basis was actually in small caps, which had been leading. They took a break this week, dropping nearly 3%. Moving on to the sectors, most of what you see at the top are more defensive areas. That's what led, when I say defensive, I mean value-oriented, dividend-paying. Most of those areas led the S&P 500. So down here, you can see the S&P 500 gained 0.42%, but consumer staples, real estate, energy, healthcare, 4 areas that I would consider either defensive, dividend-paying, value-oriented, whatever you want to call them. 4 of the 5 groups that were outperforming, or that did outperform the S&P 500 over the course of the last week, they were among those value-oriented areas. Consumer discretionary being the sole aggressive area that actually outperformed. And when the market's going sideways, I mean, this really isn't what I would consider anything to be overly concerned with. I do think that we could be in this maybe a corrective phase. I'm going to show you a chart on the S&P 500 in just a minute and what that could mean over the course of the next week or two. But I'll get to that in just a minute. Technology, you can see, actually performed exactly as the S&P 500. Technology represents over 34% of the S&P 500, and it represents over 50% of the NASDAQ 100. So when you've got that group not able to outperform, it's going to make it very difficult for the overall market to really make a whole lot of headway. And I think that's really what we saw over the last week. If you look down, industrials, financials, and utilities among the laggards, technology, like I said, kind of going along for the ride, communication services, slight underperformance there. Let's take a look at that S&P 500 chart. And as you look at it, maybe it doesn't really look that bad. I mean, we had the big move down almost 2 weeks ago. It was 2 weeks ago Friday. We rallied back off of that, nearly got to a new high. And then on Wednesday, we saw a little bit of movement back to the downside. And I think that could be starting what I would consider maybe as phase C of an ABC corrective pattern. And I'll give you this other chart annotated and show you kind of what I'm thinking. So here was the first move down, which I think could be the A. To the downside, we get a little bit of recovery. B, we come all the way back up, try to get breakout, couldn't make it. We started to see weakness on Wednesday, and this is what I'm kind of looking for. I think that this is probably the most likely scenario, but I don't rule out another breakout just because it's hard to bet against a secular bull market. But this move down to this horizontal line, and this horizontal line, by the way, you can put this into a chart under overlays. You can just pull up a horizontal line. I put in the number 6419. That is the 20-week EMA of the S&P 500. So a move back down into that level would complete a possible ABC and then would also hit just a routine 20-week EMA test on that weekly chart. NASDAQ 100, very similar. Had the big move down a couple of weeks ago. We rallied back, couldn't quite break out. Started to see a little bit of weakness on Wednesday. I think, after hours tonight, Tesla's down a bit. So maybe we get a little follow through to the downside. If we do take out the low from Wednesday on Thursday, I think that could start a little bit more of an acceleration to the downside. We'll have to wait obviously in C, but that's something I think is a very real possibility in the short term. IWM, small caps again, this past week, not a very good one, but this group last week, remember, was the only one that was breaking out to the upside. So you get a little bit on the small caps and then you give a little bit back. Feels like that's kind of what we're looking at here. Nothing bad on the chart, but very similar to the other indices. Looks like maybe you're trying to roll over here just a bit. The transports did have a pretty solid week. As I mentioned, this was the leading group among the major indices that I like to look at. And over the course of the last 5 days, we saw mostly higher prices, although finally did see a bit of selling on Wednesday, unable to clear the first key area of resistance around 16,000. So that's going to be the first target for the bulls to try and get through that level. I mentioned utilities not doing well. This is kind of just a typical pullback in an otherwise uptrending area of the market. Utilities performing really well. Conventional electricity has been a big part of this move to the upside, but we did get a bearish engulfing candle a week ago. And ever since then, you can see 5 straight down days. So we got that reversing candle off of an uptrend, pulled back. Now we're down testing that 20-day moving average. This is an area where I would be looking for some strength to resume in the utilities group. If it doesn't, and we break below 90, go below that 20-day moving average, that's when I think we could work our way all the way back down to where we broke out from, which would be down closer to $87 and approaching that rising 50-day. Healthcare actually had a really good week. As you can see, 4 of the 5 days this past week, very strong. I wanted to pull this up on a weekly chart so you can kind of see the move that we saw at the beginning of March of 2025. We got up to about 148, 147, 148. That seems to be where we're headed here. I like this weekly PPO, which is now strengthening, accelerating on the positive side of zero. I always like to see that. That just gives us a sense that the bullish momentum is accelerating. But from a price perspective, we're going to have to get through that 147, 148 area. All right. If you want to learn more about us at EarningsBeats, go over to our website, earningsbeats.com. You can sign up for a 30-day no-cost trial by simply clicking on that green button. You also can scroll down and sign up for our EarningsBeats Digest. It's our free newsletter. No credit card required. It's always free. Name and an email address. That's all it takes. And you will be subscribed. You'll join tens of thousands of other folks that have joined us on the EB Digest. This comes out Monday and Wednesday mornings. This actually, we did not send one out this morning. Probably try and get one out tomorrow. But normally our normal schedule is Monday and Wednesday. Let's keep moving on. We got a big event coming up on Saturday. And that is 2 most important drivers of market gains. We're going to talk about interest rates, which, as I mentioned last week now, 4 of the last 5 days over the last week, we have seen that 10-year Treasury yield move down below and close below 4%. So this is an area where we really haven't seen the 10-year Treasury moving down, but this is a really good signal for valuations in the stock market. It's also a really good signal that inflation is potentially under control. I've been saying that for a long time, but this is more confirmation of that. So that's what I'm looking for. We're going to talk about that on Saturday and why this matters. So make sure you are signed up. If you go to the description in this YouTube video, there will be a link where you can go and sign up with your name and email address. So definitely take care of that. We hope to see you on Saturday at 10 a.m. Eastern. All right, let's keep moving. So a couple of earnings reports that have come out here that I think are really important to the overall market, to the S&P, to the NASDAQ 100, because they both are market cap weighted indexes. So anytime you start seeing some of these larger companies report, it's a big deal. Netflix reported on Tuesday after the close. So Wednesday we get the reaction. They missed on their earnings estimate, and the stock gapped down. Not just gapping down, but notice, I'm going to annotate this chart. We actually had a gap down below some intermediate price support. So I don't think the selling is over on Netflix. I think this gap down, false breakout, we moved up early in the day, couldn't sustain it, and then finished down near the lows of the day. You can see the volume was the heaviest volume we've seen in the last year. That is not a good sign. I think we've got some more distribution coming. I think the stock is heading down to about 1060, 1065, probably to challenge the breakout that it's all above that level all the way back in, well, February top, but we broke out in April. We have not gone back to test that level. I think at a minimum, we should be looking for that. Next up, let me move on. Want to talk a little bit about Tesla. Tesla, if we pull up after hours, I will show you what Tesla is doing. It is down $15, 3.5%. That is likely to weigh on futures and on the market tomorrow, unless we get a big turnaround in Tesla. About the QQQ, we're flat. Actually, the QQQ was up more than that earlier, right after the market closed. So I do think Tesla's having a little bit of an impact. Watch again the lows that we saw on Wednesday. If we clear those lows to the downside, I think we could see the selling really start to pick back up again. All right, I want to go over maybe 5 companies that have reported earnings that maybe you're not focusing on, but I think you should. APLD, Applied Digital Corp, with their earnings that came out earlier in October, we had a huge gap up. You can see we kept trying to get through $40. We had multiple attempts up near $40. We failed, finally came down and filled the gap. This is going to be an interesting level on Applied Digital. Can we hold that gap support, which is around 29.5, and that rising 20-day moving average, which right now sits around 30? That's going to be a key level. I think the reward to risk here looks pretty strong because it has pulled back so much. Your target is up near that $40, but this literally could be where APLD turns. Again, if we are in this ABC corrective phase and the overall market goes down, that's going to make it much more difficult for just about any stock. But this is one that's at a key level. I wanted to point it out. Another stock that I wanted to point out with earnings, Delta Airlines. And by the way, let me give you some numbers here on APLD. They came out with their revenues, 64 million. Wall Street was expecting 50 million. So a huge beat on revenues. And then they were expected to lose 15 cents. They lost 7 cents. Now, moving on to Delta Airlines, I'll give you their numbers in just a minute. But you look at the chart, and what I'm seeing is a move up in a cup. I see a nice little cup. We've come all the way back up to the right side of the cup, pulling back down near the moving averages. I think Delta is a really interesting stock here. I want to show you a seasonality chart on Delta. Look at the seasonality in October and then November. So this goes back the last 13 years. So this is since we confirmed a secular bull market by breaking out in April of 2013. So since that breakout on the S&P 500 in April of 2013, that's what I'm looking at here on the Delta seasonality chart. So over the last 13 years, October has gone up 70% of the time. So October's produced higher prices, 70% of October's over the last 13 years. So that's what, like 69%, probably be 9 out of 13. Anyhow, 83% of November's have been higher. And look at that November average annual return of 9.5%. So you've got a very, very strong seasonal period coming up. And also technically, I think Delta looks pretty good here with this cup and pulling back into a handle. So this is one I absolutely would keep on my radar. Let's keep moving on. CSX. So this is CSX Corp. You might say, oh my gosh, railroads, really? These are horrible. And we're looking and look across here and CSX is up against resistance. So why do I like it? Well, I like it for a couple of different reasons. If we go and look at the seasonality, you'll see that CSX 2.2 is the average return in October, which is just so-so. But look at the average return in November. Look at that jump over the last 13 years. November has averaged going up 7.7%. And 11 of the last 12 years, CSX has risen during the month of November. So we're on the verge of a breakout on CSX. So we're on the verge of this breakout. I'm going to show you a weekly chart. So look at, I mean, as you go back here, CSX, and I'm going to also pull up the relative strength, and I'm going to go back 10 years on this chart. So CSX had been losing, well, actually on a, well, the AD line was going down. It now looks like the AD line is turning back to the upside. So we're at the highest level on the AD line in probably the last 3 or 4 years. And off of an uptrend, we have been consolidating for about 4 years on CSX. If we make a breakout, I really believe this is a stock that could take off to the upside, at least as far as railroads go. I mean, we're not talking about Palantir, we're talking about a railroad. So it's not, I wouldn't be looking for a 100% gain, but if you like stocks that are maybe a little bit less risky, a little bit less volatile, CSX pays a nice dividend. And at the same time, I think you could see some nice capital appreciation if we get this breakout. So I would certainly be watching for it. You can see CSX relative to its railroad peers over the last 10 years, it's near a 10-year high. So this is a stock that looks good technically, need to get that breakout to really confirm the bullish pattern. But seasonally, this is a stock that sets up pretty well. All right, AXP. And I haven't been giving you the numbers either. Delta, by the way, Delta Airlines came in revenues 16.6 billion. Market was expecting 15.8, and then earnings per share was $1.71 versus expectations of $1.52. CSX 3.59 billion in revenue. Market was only expecting 3.57, so I had a little bit of a beat there. And then 0.44, 44 cents was the earnings. Market was expecting 42. So we did beat top line, we beat bottom line. Technicals are lining up, seasonality's lining up, all that is lining up pretty nice. American Express breaking out. So again, money now shifting a little bit more toward these value-oriented, dividend-paying type stocks. And American Express still gives you a little element of growth in there as well. But I do like this breakout. Their numbers came in. Revenues came in at 18.4 billion. Market was expecting 18, and then earnings per share $4.14 versus market expectations of 396. So getting a breakout to confirm really solid fundamentals as well. And let me show you AXP in terms of seasonality. October average is going up 2.1%, but again, look at the jump in November, 6.8% average return on American Express over the last 13 years during the month of November. So again, it's just breaking out and it's heading into a very strong seasonal period. Last one I have for you now is GM. So let's pull up General Motors. The numbers, revenue 48.6 billion. Market was only expecting 44.3. That's a huge beat, revenue beat for GM. And earnings per share were expected to come in at 228. They came in at 280. So a huge beat top line, huge beat bottom line, and a really nice breakout. And the thing that looks good here for GM, if we go back, I mean, I can pull up a 10-year chart. Look at where we're now in uncharted territory, breaking out above the high that we saw all the way back at the beginning of 2022 when we got up to about 64, maybe $65 a share. Closed today at 67.31, breaking out. And you can see the volume on the breakout was the highest that we have seen in the last year. Very, very solid volume. GM looks good. And again, if we look at seasonality, look at GM. It loves October, averaging 6.3% per October over the last 13 years. And it gets even better, 7% average annual return or average return just during the month of November over the last 13 years. And GM has gone up 11 of the last 12 years. So these are all companies, these last four anyway, looking at Delta, CSX, American Express, and General Motors, all companies I think looking good on their charts technically, and also moving into a very strong seasonal period at a time when the market usually does rotate toward these stocks. So I think these are four. I just gave you five stocks with earnings that look good to me. But those last four in particular, I think carry a little bit less risk than many of the technology names that we talk about a lot. And they are moving into a period when they tend to do well. All right, last thing I want to do is I want to talk about some of these momentum stocks that have absolutely been getting killed here over the last week. What is going on? IREN, IREN, this stock had gotten up to almost $75. And in 6 trading days, we had reversed, and today's low went all the way down to 48. So it lost more than 1/3 of its market cap in just the last 6 trading days from the high that we saw 6 trading days ago. So where do these stocks find support? Well, you got some gap support coming in here just above $50. We held that. If we go back down below Wednesday's low, I think we could be moving all the way back down to $40 in the stock. But I think there's a chance that this gap support holds right here near $50. We need to get back up through that 50-day moving average. Next stock, how about Bloom Energy? $126, 6 trading days ago, over 125. And now today's low, 88. So these darlings that we have had for quite a while, all of a sudden, and this is the risky part of investing in these stocks and chasing them, is that when they pull back, they tend to pull back really hard. Now, excuse me, like IREN, this is a big gap support level that it went down, got very close to on Wednesday. Just about $86, $87 is gap support. We came down from 126 and got within about $1 of gap support. So this is an area for Bloom Energy that I think needs to hold. OKLO, OKLO. This is one that I actually talked about with members last Tuesday evening. We did our monthly Max Payne event. And I talked about the fact that market makers could make up to $100 million if OKLO were to fall back to its Max Payne level, which I believe was $130. And what I said was, I would be very careful. I would not be a buyer of OKLO, knowing that market makers have incentive, financial incentive to move the stock lower in the near term. The next morning, it gapped up, went all the way up almost to 195. And look at where we are now. Today's low got down to 114. So we had that massive reversal. Market makers were literally ringing that cash register over and over and over again last week, as in my opinion, they manipulated prices lower on OKLO and some others as well. But this was one that we specifically talked about last week in our event. NBIS, this goes back a little bit further, probably about 8 or 9 trading days. We were up to 140. Today's low came all the way down, hit the 50-day moving average. Also, this breakout level around 98. This is an area where NBIS needs to turn and move back to the upside. I think it's got a clear shot potentially back to that 20-day moving average, and then we'll see if it can get through. But this one, beaten up, like I said, over the last 10 days, a lot of red-filled candles you can see there. AD line's taken a big hit. It's now moved down to a multi-month low. Maybe this doesn't hold on to its support level, but this is the support, the first key initial support level that NBIS needs to hold. SATS, Echo Star Holding. This one's been kind of drifting lower for quite a while, but it had moved from $30 to $85 in about 2 weeks. And now it's gone back from 85 to 72. I think this pullback, I would be watching gap support at 67.50, the recent low around 69. I think that's where the stock needs to hold on any continuing pullback. CLSK, this is CleanSpark. Big move up to 23. You can see from $9 to 23 in about 6 weeks. Now we've turned around from 23.50. Today we were down to 16.23 at the low. And looking back, I mean, it does look like we had a breakout probably around 17 and a half, closed a little bit below that. I don't know. There was some congestion down here around 15. Maybe we head down to about 15 before we can get a nice rally. And what about gold? Gold never seemed to want to go down. All of a sudden now in 2 days, we've seen the GLD drop from 403 down to the low intraday of 368. That's $35. That's about 9% move to the downside in 2 days on the gold, even though we did rally off that 20-day, which I think is a good thing. Short term, that's where you absolutely want to rally from. If we close below 370, I think that opens the door for some more losses in gold. But I would expect it to hold here, and especially if I'm right about the market keeps going down, I think GLD should be a beneficiary. If the volatility index goes up and more fear grips the market, normally we see money rotating into gold. So that's something to keep in mind and perhaps look for. Last one I have for you is Agnico Eagle Mines. That's in that mining area. And with gold dropping, many of the miners took big hits. Agnico, which was up over 185 to about 187, 188, has pulled back and on Wednesday's low hit 158. So we're talking about almost a $30 move back to the downside, which is roughly about 26, 27%. Pretty big hit to the downside on AEM. All right, that is about it for me. Again, I think some of these growth stocks that have been doing so well, got to be careful with them. When they move up, they're great, but when the market sells off, you can see some of these do take really big hits. So just understand what you're buying. Anyhow, something to think about anyway. All right, that is it for me this week. Let's see what the market has in store. I will mention that we are now in the worst week of the year historically, which also adds to the reason why I think maybe we get a little bit more selling this week. But the good news, at Monday's close of next week, we start the most bullish period of the year. I'll talk more about that next week. Have a great week, everybody. Happy trading.